December 3, 2024, marked a turning point that one of Wall Street's giants had been desperately trying to prevent for over a decade. On that day, JPMorgan Chase found themselves staring at delivery demands for 5.2 million ounces of physical silver. Demands they couldn't postpone, couldn't pay off in cash, and most importantly, couldn't simply make disappear. This scenario wasn't part of their playbook. You see, the entire futures market for silver operates on a single critical premise that when push comes to shove, traders will accept dollars instead of actual metal. But when silver hit $59 an ounce, that premise shattered into pieces. And now JPMorgan finds itself caught in a snare of its own making. Let me walk you through how futures markets typically function in our modern financial world. Most of us picture these markets as venues where tangible goods change hands, right? But here's something that should make you pause and think. Looking at historical COMEX records, a staggering 95% of silver futures have traditionally been settled with cash payments rather than physical delivery. In other words, out of every 100 paper promises for silver, only 5 result in someone actually taking possession of the bars. The remaining 95 participants simply collect their gains or absorb their losses in currency and move on. This arrangement creates an extraordinarily profitable setup for the financial institutions operating these trading platforms. When only 5 contracts out of 100 require actual metal, you can theoretically write 100 commitments while keeping just 5 ounces of genuine silver stored away. It's essentially the same principle as fractional reserve banking, except applied to precious metals markets. You make delivery promises to everyone while knowing from statistical analysis that hardly anyone will actually come to claim their metal. For multiple decades, this mechanism functioned flawlessly because the underlying assumption remained valid. However, JPMorgan didn't merely take part in this arrangement. They completely dominated the landscape. Throughout the period from 2010 to 2020, they established themselves as the absolute largest vault operator within the COMEX system. Why would the most powerful bank in the United States want to manage facilities storing silver bars? Because having control over the storage facilities meant having control over the entire delivery mechanism. During those uncommon instances when someone actually insisted on physical metal, JPMorgan could simply reorganize inventory between their eligible and registered categories, manufacturing the illusion of plentiful supply without actually purchasing new metal from the broader market. But here's where things take a fascinating turn. Back in June 2021, a significant change swept through the international banking landscape that flew completely under most people's radar. The Basel III global banking standards took effect throughout Europe, with gradual implementation eventually reaching American markets over subsequent years. Hidden within those regulatory modifications was a technical reclassification that sounds incredibly mundane until you grasp its actual implications. Unallocated precious metals, which is the technical term for paper claims on metal that hasn't been specifically set aside for you personally, were downgraded from Tier 1 assets to Tier 3 status. What's the practical meaning in everyday language? Financial institutions can no longer treat paper promises for metal as premium quality holdings on their accounting books. If you're maintaining a derivative position that guarantees silver delivery, you now must support it with genuine physical metal, not simply another paper commitment. The fractional reserve approach just got eliminated by international banking regulations. No major press conferences, no sensational headlines, just a regulatory adjustment buried in legal documents that rendered the previous manipulation tactics mathematically unsustainable moving forward. Now, you're probably curious why this becomes critical right now, particularly at the $59 price point. Here's a question to consider. What occurs when silver prices breach specific threshold levels that fundamentally alter the economics of market participation? At $58.50, according to data from the mining sector, silver extraction becomes sufficiently profitable that major production companies like First Majestic Silver and Pan American Silver began making strategic choices. Rather than channeling their freshly mined silver into COMEX storage facilities at exchange rates, they started selling straight to industrial consumers at superior prices. Why would you supply the exchange that's been artificially depressing your product's value for years when manufacturing companies are prepared to pay higher premiums for guaranteed availability? Then there's the Asian dimension that most Western investors don't completely grasp. The Shanghai Gold Exchange, where physical metal genuinely trades in Eastern markets, witnessed silver prices reaching the equivalent of $62 in yuan during November. That differential created what market professionals call an arbitrage window. Purchase silver from COMEX warehouses at $59, transport it to Shanghai, liquidate it for $62. Simple geography combined with basic mathematics. But here's the outcome. COMEX stockpiles decreased by 4.1 million ounces just in November, based on exchange records as metal flowed eastward to capture that pricing differential. But the genuine pressure at $59 originates from an entirely separate category of purchaser, industrial consumers. We're discussing solar panel manufacturers, electronics corporations, and electric vehicle producers who require silver for genuine manufacturing, not financial speculation. These organizations employ supply chain executives whose entire responsibility centers on securing materials for their 2025 production commitments. When silver crosses $59, it activates something resembling panic mode in purchasing departments because this price threshold signals potential shortage scenarios on the horizon. Consider what this means from their vantage point. You're accountable for acquiring 10 million ounces of silver for your company's solar panel assembly operations next year. Your complete manufacturing timeline depends on that material arriving punctually. At $58, you might hold off and hope for a price correction. At $59, you abandon hope and commence emergency buying because the expense of failing production objectives far surpasses the cost of paying elevated rates for guaranteed metal. These industrial purchasers, the ones who genuinely need physical delivery, essentially remove themselves from serving as the liquidity cushion that speculative traders normally depend upon. So here's the predicament that JPMorgan constructed for themselves, and it's entirely mathematical with zero escape possibilities. They amassed 947 million ounces in paper short commitments between 2008 and 2020, according to CFTC Commitment of Traders information. That represents nearly 1 billion ounces in delivery promises. The approach was elegant in its straightforwardness. Assume the short position on futures agreements, collect premium payments, and almost never actually hand over metal because 95% resolve in cash. Maintain vault control, maintain game control, repeat the pattern for 15 years. But Basel III transformed the equation by mandating physical backing for those paper commitments. Their vault stockpile, which reached maximum levels at 47 million ounces in early 2023, has plummeted to merely 8.9 million ounces currently. That represents an 81% reduction rate in under 2 years. And at $59 per ounce, delivery requirements are intensifying because all three stress points, mining supply retention, Asian arbitrage activity, and industrial emergency purchasing are converging simultaneously. Every single ounce that JPMorgan hands over to fulfill one agreement diminishes the physical reserves supporting their remaining paper commitments. Every ounce they decline to deliver demonstrates the market is fundamentally fraudulent and provokes additional delivery demands from contract holders who recognize the system is exposed. They cannot prevail. They cannot withdraw. And time is running short because registered inventory throughout all COMEX facilities just reached 28 million ounces. Sufficient to satisfy merely 8.4 days of present delivery demand velocities. Let me frame this perspective for you. Picture yourself writing 100 checks promising to pay individuals $1,000 each. You maintain only $5,000 in your banking account because historically only 5 people ever actually cash their checks. Everyone else simply exchanges the checks among themselves as though they're currency. But then the framework changes. The bank informs you that you require actual funds backing every check you issued. And abruptly people begin arriving to cash those checks because they comprehend you might not have sufficient backing. How much time before your account empties and you're confronting overdraft penalties? That's JPMorgan's current situation, except we're discussing billions in value and a commodity that the entire contemporary economy relies upon. This isn't conspiracy speculation. This isn't guesswork. This is mathematics manifesting in vault inventory documentation, delivery notifications, and regulatory submissions. And the calculations indicate JPMorgan is ensnared in a predicament they cannot exit without either acknowledging fraud or completely exhausting their physical reserves. The delivery notification they received on December 3rd for 5.2 million ounces, that's not the conclusion of this narrative. That's merely the initial domino toppling in a sequence that could fundamentally reshape the entire precious metals marketplace. Because once participants realize that America's largest bank cannot deliver the silver they committed to, everything transforms and it's already commenced. Now, I understand your thoughts. This resembles another wild theory about major banks manipulating markets, correct? Except this time we possess the documentation, and not arbitrary documentation. Official government statistics, regulatory settlement agreements, and JP Morgan's own Securities and Exchange Commission submissions that present a narrative so transparent that even those orchestrating the manipulation couldn't conceal it. Let's begin with the CFTC Commitment of Traders publications. These are accessible documents that the Commodity Futures Trading Commission distributes weekly, displaying who maintains what positions across every significant commodity marketplace. Consider it a leaderboard revealing which participants are positioned bullish and which are positioned bearish. Throughout more than 10 years, these publications revealed something that should have activated warning signals at every regulatory organization in our nation. JPMorgan Chase maintained a concentrated short commitment, averaging 32% of the complete COMEX silver marketplace between 2010 and 2024. Let me emphasize that point. A single financial institution controlled nearly 1/3 of all short commitments in the American silver trading arena. During March 2020, their position climaxed at 40,550 contracts, representing 202 million ounces of silver they had committed to deliver if requested. To establish perspective, that exceeds the silver most mining corporations extract over 5 years. Here's where circumstances become genuinely compelling, though. The CFTC maintains position threshold regulations specifically created to prevent precisely this situation. These regulations restrict how substantial any individual entity's commitment can become in a commodity marketplace. The threshold for silver stands at 9,000 contracts. So how did JP Morgan maintain 40,550 contracts, which constitutes 4.5 times the legal threshold? They asserted an exception. Based on their documentation, all those short commitments were categorized as hedging operations for their vault functions and banking activities. Contemplate what that signifies. You're permitted to exceed position thresholds if you assert you're mitigating legitimate commercial risk. But if you're operating vaults specifically to enable the manipulation and subsequently employing those vault functions as justification for unlimited position dimensions, you've manufactured a perfectly self-reinforcing arrangement. It's comparable to owning a gambling establishment. Manipulating the odds and subsequently asserting your wagering merely hedges your establishment's commercial risk. The regulators accepted this rationalization for 14 years. But the proof didn't remain concealed indefinitely.
During September 2020, JP Morgan consented to remit $920 million to resolve accusations with the Department of Justice and the CFTC. The accusation, spoofing, that's the technique of submitting substantial false orders on the exchange to manipulate valuations, then withdrawing those orders before completion. Based on the DOJ examination, JP Morgan traders submitted thousands of spoofing orders across precious metals marketplaces between 2008 and 2016, manufacturing false impressions of availability and appetite to shift prices favorably, $920 million. That represents the most substantial precious metals manipulation penalty in American history. And here's the component that should provoke outrage. JP Morgan wasn't required to acknowledge misconduct, but they remitted the penalty, issued a declaration about enhancing their oversight, and preserved their massive short commitment completely unaffected. The fundamental manipulation, the concentrated commitment that provided them marketplace domination, was never confronted. They remitted what constitutes operational expenses and perpetuated the identical approach for another 4 years. The CFTC statistics from November 2024 convey precisely why this matters presently. For the initial occasion since 2008, JP Morgan's silver short commitment descended below 15,000 contracts. That's not because they chose to voluntarily abandon their profitable approach. That's because they're being compelled to hand over physical metal to fulfill agreements. and each delivery represents a forced termination they cannot obscure anymore. The arrangement functioned for 14 years because the paper activity never had to transform into a physical transaction. But at $59 per ounce with Basel III implementation, the physical transaction is the exclusive option remaining. Now, if you want to comprehend where this trajectory leads, you need to know the account of what transpired the previous occasion someone attempted to monopolize the physical silver marketplace. March 1980, the Hunt brothers, Bunker Hunt, alongside his sibling Herbert, accumulated 59 million ounces of physical silver between 1973 and 1980, propelling the valuation from $6 per ounce completely to $49.45, adjusted for monetary inflation. That's equivalent to $187 in contemporary currency. The Hunt brothers' approach was straightforward and devastating. Acquire futures agreements, insist on physical delivery, and compress the shorts who believed they could vend paper indefinitely. By early 1980, they had accumulated such substantial metal that COMEX confronted a critical situation. The exchange simply lacked adequate physical stockpile to fulfill delivery requirements if the Hunt brothers maintained rolling their agreements forward and assuming possession. The complete marketplace framework approached collapse. So COMEX executed what regulators consistently execute when powerful entities face losses. They modified the regulations during active competition. On January 21, 1980, the exchange implemented what became recognized as Silver Rule 7. This emergency provision prohibited new long-only commitments in silver futures. You could exclusively participate in the marketplace if you were terminating an existing commitment or hedging. The objective was explicit. Halt the Hunt brothers from accumulating additional quantities and compel them to liquidate. The consequence was instantaneous. Silver crashed from $49 to beneath $11 across merely 4 months. The Hunt brothers faced bankruptcy. The short sellers received rescue, and the lesson became transparent. You cannot defeat the exchange because the exchange will modify regulations to safeguard itself. Fast forward to present circumstances, and the situation contains one critical distinction that renders all historical comparisons both alarming and exhilarating. The present delivery pressure encompasses 862 million ounces of outstanding interest throughout all COMEX silver agreements. That's 14 times more substantial than what the Hunt brothers accumulated. But here's the predicament for regulators. They cannot simply implement Silver Rule 7 version 2 because Basel III international banking standards now supersede COMEX regulations. Let me clarify why this matters tremendously. Basel III represents international banking legislation implemented throughout the United States, Europe, and major financial centers globally. It's not a COMEX regulation that some exchange committee can ballot to suspend during marketplace turbulence. The mandate that financial institutions maintain physical backing for unlocketed metals derivatives isn't something JPMorgan can lobby to eliminate or that regulators can disregard during emergency situations. Contravening Basel III signifies violating international banking compliance frameworks, which activates ramifications far exceeding merely receiving penalties from the CFTC. So you have circumstances where historical precedent indicates modify regulations and safeguard the short spur. The regulatory architecture indicates you cannot modify these specific regulations without activating a worldwide banking compliance emergency. The Hunt brothers represented one family that could face bankruptcy through regulation modifications. Today's delivery pressure originates from industrial consumers who require the metal for manufacturing, sovereign wealth organizations protecting currency holdings, and thousands of individual investors who absorbed the lesson from 1980 and recognize the paper system is manipulated. You can bankrupt one billionaire, you cannot bankrupt the complete industrial supply network without collapsing the economy. But here's the definitive proof that conveys JPMorgan recognizes precisely how ensnared they are, their own SEC documentation. That's every quarter. Publicly traded financial institutions must submit 10Q reports detailing their financial commitments, including derivatives, vulnerability. In Q3 2024, JPMorgan's precious metals derivatives portfolio decreased by $14.7 billion. Simultaneously, their physical metal possessions increased by 2,100 tons based on vault inventory disclosures. Contemplate what those figures signify. The financial institution that has maintained the most substantial short commitment in COMEX silver for 14 years is concurrently terminating derivatives commitments and accumulating physical metal. This isn't conventional portfolio adjustment. This is institutional emergency response. They're not executing this transition because they suddenly accept silver as an investment. They're executing this transition because they recognize the paper marketplace will fail and they require physical metal to survive approaching circumstances. And if you believe I'm interpreting excessive significance into their commitment modifications, examine the risk management portion of their most recent 10Q submission. There's a statement buried in the legal disclaimers that communicates, and I'm rephrasing here. Physical delivery requirements may surpass available stockpile during intervals of marketplace turbulence. That's corporate attorney terminology for we might not possess capacity to deliver what we committed. They're communicating the predicament exists directly there in regulatory submissions that they are legally obligated to distribute. They're simply wagering that nobody examines the detailed provisions. The Hunt brothers demonstrated that a concentrated physical commitment could fracture the paper marketplace. The 2020 resolution demonstrated that JPMorgan manipulated silver valuations for years. Basel III eliminated the escape mechanisms that rescued the shorts in 1980. And JPMorgan's own behaviors, terminating paper shorts, acquiring physical metal. demonstrate they perceive approaching circumstances and they're attempting to position advantageously before the predicament completely closes. This isn't speculation. This isn't theoretical analysis. This is documented proof from government publications, regulatory resolutions, and corporate submissions.
This isn't speculation. This isn't theoretical analysis. This is documented proof from government publications, regulatory resolutions, and corporate submissions. The 14-year manipulation arrangement didn't terminate because JPMorgan experienced ethical transformation. It's terminating because the mathematics of physical delivery under new banking standards rendered continuation impossible. They constructed the predicament. They became captured within it. And now they're scrambling to withdraw before everyone else comprehends the emperor possesses no silver. So here's the inquiry that matters most to you. What transpires subsequently? And how elevated does silver actually ascend when this predicament completely activates? The response is entirely mathematical, and the calculations are absolutely devastating for anyone positioned short on this transaction. Let's commence with the stockpile figures because this is where the paper fantasy encounters physical actuality. As of December 2024, total COMEX registered silver stockpile, that's the metal that's genuinely allocated and accessible for delivery, stands at 28.4 million ounces. There's another 186 million ounces positioned in what's designated eligible stockpile, which signifies it's within COMEX storage facilities, but not designated for delivery. Consider registered as prepared for shipment and eligible as in storage but committed elsewhere. Now here's where the mathematics becomes unavoidable. Total outstanding interest throughout all COMEX silver agreements represents 862 million ounces of paper commitments. That's 862 million ounces that agreement holders possess the legal authority to request as physical delivery. So we possess 28.4 million ounces accessible to deliver against 862 million ounces of commitments. That's a proportion of roughly 30-1. 30 paper commitments for every individual physical ounce genuinely positioned in deliverable configuration. You might be contemplating, but didn't you communicate that 95% of agreements historically resolve in cash? You're precisely correct. That's how this framework survived for such duration. The complete architecture depends on that premise remaining valid. But let's execute a straightforward calculation that reveals why $59 per ounce fractured that premise permanently. What transpires if merely 3.5% of outstanding interest requests physical delivery instead of the historical 5%? 3.5% of 862 million ounces equals 30.2 million ounces. Accessible registered stockpile equals 28.4 million ounces. We're already in shortage territory. And we haven't even reached the conventional historical delivery velocity yet. That's how minimal the buffer is. The framework possesses no cushion remaining. And recall what I communicated about December 2024. JPMorgan received delivery notifications for 5.2 million ounces in that individual month. If that delivery velocity continues, and remember, this is the initial month where silver maintained above $59, then at 5.2 million ounces monthly, the complete registered stockpile becomes exhausted in 5.4 months. We're examining May 2025 as the mathematical termination point where the deliverable silver simply depletes. But here's where circumstances become even more compelling. Because that timeline presumes delivery velocities remain constant. In actuality, delivery requirements accelerate as stockpile diminishes. Why? Because once marketplace participants comprehend that stockpile is depleting more rapidly than it can be replenished, the rational response is to request delivery immediately before the storage facilities are vacant. It's a financial institution panic, except the institution is a storage facility and the deposits are silver bars. If delivery velocities increase to merely 7 million ounces monthly, which is completely reasonable once emergency response initiates, you're examining a March or April 2025 termination point. That's 3 to 4 months from present moment. And here's the elegant predicament within the predicament. JPMorgan cannot extract from eligible stockpile to replenish registered without activating the precise death spiral they're attempting to prevent. Every ounce they transfer from eligible to registered is an ounce they're acknowledging isn't supporting some alternative paper commitment, which activates additional delivery requirements from agreement holders who comprehend the support isn't present. Now you might be questioning whether new availability could rescue this circumstance. Perhaps miners amplify extraction, or perhaps stockpile flows in from alternative sources. Let's discuss why that's not transpiring using statistics from the Silver Institute that monitors worldwide availability and appetite fundamentals. Industrial silver appetite for 2025 is projected at 642 million ounces. The solar panel sector alone necessitates 247 million ounces for next year's manufacturing. That's a 49 million ounce elevation from 2024 quantities, because solar capacity is expanding internationally as nations advance toward renewable energy objectives. Then you possess electric vehicles which consume 25 to 50 grams of silver per vehicle in various electrical components. With 17 million EVs projected for manufacturing in 2025, that's another 15 to 25 million ounces of new industrial appetite that didn't exist 5 years previously. Total worldwide mine availability for 2025 is projected at 843 million ounces according to mining sector predictions. So, if industrial appetite is 642 million ounces and total availability is 843 million ounces, that produces a surplus of 201 million ounces for investment appetite, coinage, and yes, COMEX warehouse stockpile. But here's the difficulty. That 201 million ounce surplus used to be 340 million ounces back in 2020. The surplus is contracting annually as industrial appetite expands. And that contracting surplus was the cushion that permitted paper marketplaces to operate. More significantly, industrial consumers are presently remitting premiums to secure availability directly from miners rather than competing in exchange marketplaces. When First Majestic Silver can vend directly to a solar manufacturer at a $2 premium over COMEX valuations with guaranteed delivery schedules, why would they channel metal into a warehouse framework controlled by financial institutions that have manipulated valuations downward for years? The response is they won't, and without miner collaboration in channeling COMEX warehouses, there's no mechanism to replenish stockpile as it exhausts. So the availability cannot rescue them. The stockpile calculations don't function, and industrial appetite is eliminating the surplus that previously cushioned the paper marketplace. That brings us to the final calculation. How elevated does silver ascend when these mathematical certainties become transparent to everyone? For this, we need to examine historical precedents of short compression dynamics in alternative marketplaces. The Volkswagen short compression in October 2008 provides the most transparent pattern. In that circumstance, Porsche secretly accumulated Volkswagen shares while a substantial short commitment existed. The compression transpired in 3 distinct stages. Stage 1 was a gradual 300% valuation gain over 2 years as Porsche accumulated. Stage 2 was a pause and consolidation interval where shorts attempted to terminate. Stage 3 was a vertical spike of 380% in 48 hours when the marketplace comprehended. Physical shares were exhausted and couldn't be borrowed. Silver has already completed Stage 1. From the 2020 minimum of $18 to the present $59 represents a 327% gain over roughly 4 years. We are entering Stage 2 presently. JPMorgan's compelled deliveries in December represent their attempt to terminate short commitments before the circumstance becomes uncontrollable. Stage 3 activates when registered stockpile descends below 10 million ounces, which represents approximately a 10-week availability at present delivery velocities. That's the point where the marketplace comprehends the metal is genuinely depleted based on historical precious metal compression precedents and present availability appetite fundamentals. Here are the valuation objectives with their corresponding probabilities. Conservative situation, $120 to $150 per ounce. That's based on the gold to silver proportion returning to its historical average of 40 to 1. With gold presently around $4,000. That calculation provides you silver at $100. The conservative estimate adds a 20 to 50% premium for availability constraint. Moderate situation, $200 to $250 per ounce. This is equivalent to the 1980 maximum valuation adjusted for inflation. Recall, silver reached $49.45 in 1980, which equals approximately $187 in contemporary currency. The moderate situation presumes we match that inflation-adjusted maximum with an additional premium for the reality that industrial appetite is far more elevated presently than it was in 1980. Vertical spike situation, $295 to $350 per ounce. This is what transpires if industrial supply networks panic. Envision you're a procurement executive at a major solar manufacturer with $1 billion manufacturing assembly that terminates without silver delivery. At what valuation do you cease caring about expense and commence emergency acquiring whatever metal is accessible? $300 per ounce is economical if the alternative is failing manufacturing quotas that expense your corporation 10 times that amount in forfeited revenue. When industrial consumers compete with investment appetite and there's no accessible stockpile, valuations don't ascend progressively. They spike vertically. The timeline for these situations is second quarter to third quarter 2025, somewhere between 6 and 9 months from present moment. That timing is based on present delivery velocities, stockpile exhaustion mathematics, and the characteristic duration of stage 2 consolidation in historical compressions. If industrial emergency acquisition accelerates the timeline, we could observe the spike as early as April or May. If delivery requirements decelerate temporarily as JPMorgan manages to postpone or negotiate some resolutions, it could extend to August or September. But the mathematical termination point is identical regardless of minor timing variations. Now I want to be exceptionally transparent about what I'm communicating and what I'm not communicating. I'm not instructing you to acquire silver. I'm not providing you investment counsel. I'm presenting you the mathematics of a circumstance that is manifesting in real time with publicly accessible statistics. The stockpile figures are distributed by COMEX. The delivery requirements are documented in exchange publications. The industrial appetite projections originate from the Silver Institute. JPMorgan's commitment modifications are in their SEC documentation. This is not prediction. This is calculation based on verifiable information. What I am conveying to you is that you're observing a mathematical predicament closing gradually. JPMorgan engineered a 14-year arrangement to dominate silver valuations through paper manipulation. They accumulated a concentrated short commitment that was excessively substantial to conceal and excessively substantial to terminate without shifting marketplaces. They constructed a framework that functioned flawlessly as long as 95% of agreements resolved in cash and nobody requested physical delivery. They controlled the storage facilities, controlled the valuation, and generated billions in trading profits by maintaining silver artificially suppressed. But Basel III eliminated their escape mechanisms by mandating physical backing for paper commitments. $59 per ounce activated delivery requirements from miners, industrial consumers, and international arbitrage that drained stockpile more rapidly than it can be replenished. And now they're being compelled to deliver physical metal they don't possess to fulfill agreements they never anticipated would be requested. Every ounce they deliver brings them closer to default. Every ounce they decline to deliver demonstrates the fraud and activates additional delivery requirements. The calculations are straightforward. 30 paper commitments for every physical ounce signifies only 3.5% of agreement holders need to request delivery to exhaust accessible stockpile. At present delivery velocities, that transpires in 3 to 5 months. And historical compression patterns reveal that when physical scarcity becomes undeniable, valuations don't ascend gradually. They spike vertically. This is not a conspiracy theory. This is not speculation, this is mathematics. And the calculations communicate that the most substantial financial institution in America is ensnared in a commitment where they committed to deliver almost 1 billion ounces of silver while maintaining less than 30 million ounces in accessible stockpile. They cannot prevail. They cannot withdraw. And the clock is counting down. The calculation is straightforward. The conclusion is inevitable, and it's already commenced. The exclusive inquiry remaining is how elevated does silver ascend when everyone else comprehends what the calculations have been communicating for months. Because at $59 per ounce, we're not at the termination of this narrative. We're merely commencing.